Hey everyone, and welcome. Today we are going to dive deep into the National Bank of Canada. We're going to break down a recent analyst report from Morningstar that, honestly, presents a really fascinating puzzle.
So, this is the big question, right? Is this stock a huge opportunity or something you should stay away from? Because on the surface, the signals are, well, they're pretty confusing. The bank seems to be firing on all cylinders, but at the same time, the analyst is waving a big old warning flag. So which is it? Let's dig in.
And this, right here, gets to the absolute heart of the problem. You've got the analysts saying, hey, we think this company is truly worth about 132 Canadian dollars a share. But then you look at the market and people are actually paying over 172 bucks for it. Whoa, that is a huge gap that we really need to understand.
Okay, this quote right here from the analyst, Mo-Yuan Chen, sets up our entire puzzle. They're saying we're increasing our fair value estimate, which, sounds like fantastic news. But then in the very same sentence, they call the stock overvalued. How on earth can both of those things be true at the same time? Let's find out.
So yeah, it's a bit of a head-scratcher for investors. It's really a story with two different parts. You've got the good news about how well the bank is actually doing, and then you have the bad news about its stock price. Let's break down both sides of this.
All right, let's start with the good stuff. Why did the analyst even raise their estimate in the first place? Well, it all comes down to one simple thing. The bank is just performing way better than anyone expected.
The report neatly breaks down that $14 valuation bump into four pieces. A couple of bucks is just from what they call the time value of money. Basically, money now is worth more than money later. But the real heavy lifting, that's the $11 jump from better profit forecasts in the short term, plus another $4 from a rosier medium-term outlook. That little minus $3 at the end for share repurchases, that's just a small accounting adjustment for the bank buying back its own stock.
So, here's the crucial question. Where are all these extra profits coming from? Well, the report points a giant finger at one specific area that's been doing incredibly well, the capital markets segment. And even more specifically, its trading business.
And when I say incredibly well, I mean it. Check this out. 72%. That's the one-year increase in the bank's total revenue from trading activity. According to the report, that brought their total trading revenue to a massive 2.15 billion Canadian dollars for the 2025 fiscal year. I mean, wow.
Okay, so that all sounds amazing, right? But here's where the story takes a turn. That incredible performance is also the very reason the analyst is so concerned. Let's pivot to the second part of our story, the bad news about that overvalued stock price.
This chart really illustrates the analyst's caution perfectly. You can see the bank's trading income just skyrocketing. I mean, it went from under $1 billion in 2022 to nearly $5 billion by 2025. The report flags that this single, very volatile source of income is becoming a huge part of the bank's profit. And that can be a pretty risky game.
And that brings us right to the analyst's main argument. They basically believe the market is getting a little too excited, looking at these gigantic trading profits and just assuming they're going to go on forever. The analyst's take is that these results are likely temporary, above mid-cycle levels, and probably aren't sustainable in the long run. Now, to really get why that word sustainability is so important, we need to look past the short-term numbers. We've got to understand the bank's fundamental competitive advantages, or what analysts like to call its economic moat.
So what the heck is an economic moat? Well, think of a medieval castle, right? The moat is that big ditch of water around it that protects it from attackers. In business, it's the same idea. It's a structural advantage, like a powerful brand or high costs for customers to switch to a competitor, that protects a company and lets it earn great profits for a long time.
Morningstar actually uses this moat idea to rate a company's defenses. If a company has a wide moat, that means its advantages are super strong and durable. A narrow moat means the advantages are solid, but maybe not quite as powerful. And, well, no moat means there's really nothing stopping competitors from coming in.
So why does the National Bank of Canada get a narrow moat rating instead of a wide one like some of its bigger Canadian rivals? Well, the report gives a few key reasons. For one, it's the sixth largest bank, so it just doesn't have the sheer scale of the others. It's also really concentrated in one province, Quebec, and its other businesses outside of banking aren't as dominant. It's a good business for sure, but its defenses aren't exactly impenetrable.
Okay, so to get the complete picture here, let's look at both sides of the coin. We need to weigh the main arguments for and against the stock, what the bulls and the bears are saying. The case for the bulls is pretty straightforward. It's the most Canadian-focused of the big banks, which some people like. It has less exposure to those super-hot housing markets in Toronto and Vancouver, and its recent buyout of Canadian Western Bank, or CWB, helps it grow. But the bears, they're worried about bigger-picture risks like a trade war sparking a recession, the challenge of actually integrating CWB successfully, and potential risks from its bank in Cambodia.
So, after weighing all of this, the strong results, the valuation risk, the narrow moat, and the arguments from both sides, what's the final verdict from the analyst? What's the bottom line?
Honestly, this one graph from the report pretty much says it all. That bottom line is the analyst's estimate of what the bank's stock is actually worth. And the line above it, that's the real stock price. You can see they used to track each other pretty closely, but just recently, whoosh, the price has shot way above what the fundamentals seem to justify.
And that leads us to this simple, clear conclusion. The National Bank of Canada is a good company. It's a solid bank with a decent, narrow moat protecting it. But the stock price has just gotten ahead of itself. At this level, it's basically priced for perfection, and that doesn't leave much room for error if those volatile trading revenues start to cool off.
And that's really the crucial takeaway here. This whole thing highlights the critical difference between a good company and a good investment. The analysis is clear. This is a good company. But for you, the investor, the final, all-important question it leaves us with is this: at what price? Thanks for tuning in.